Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Micro-cap stocks can be seen as risky by some, but for those with the right experience, they can unlock a world of opportunity. Our guest today manages Fidelity Global Micro-Cap Fund, and it leverages a unique approach that combines value, quality, and both quantitative as well as fundamental analysis to find some hidden gems. Where is he finding the best opportunities right now, and how might US policy shifts and global valuations impact microcap investors? Happy to say that joining us here today to share his investment style and how he's navigating the global markets, and it really is a global story, is portfolio manager Salim Hart. Hi, Salim, great to see you.
Hey, Pamela, good to be here.
So let's go into this space. You've spoken to us about it before, but it is quite fascinating. Actually, if we can begin with just how global some of these companies are that you're looking at. This is not just a US index fund.
Yeah, I think that's the interesting thing people don't realize that much about microcaps is that while global benchmarks and even the small and large cap space tend to be dominated by US companies, MSCI World, small cap is actually over 60% US. The microcap space is much more geographically diverse. So the MSCI World Microcap benchmark itself is only about 29% US. So if you think about less than a third of stocks in the microcap universe are actually based in the US. So it does give investors that diversification globally and the opportunities to kind of select from a broader set that's less US focused.
Okay, so let's talk about that diversification, as you're saying. So there's the global piece of it, which right now is there's certainly a discussion of an everything else trade. So it fits with that, for instance. But it almost acts a little bit as an alt, because some of the companies in them, if they're smaller, they're not going to have, I guess, the massive liquidity. There'll be elements to it that trade quite differently to other types of stocks. Maybe just go through some of those highlights of how a micro cap trades, first of all.
Absolutely. I mean, outside of just the liquidity aspects, they are difficult to trade, and we can talk about that. That's one of the challenges, but opportunities out there. They tend to be very local in their business nature. So, I get a question obviously about tariffs a lot these days, and most of the microcap stocks actually are less affected by trade than many of their mid to large cap peers. So, for example, there's a there's a retailer that does building supplies, like a small Home Depot in Germany, and it sells to local consumers in Germany. And they'd actually probably benefit to some extent from tariffs because instead of exporting things to the U.S., there's going to be more opportunity for them to buy their goods on the global marketplace at maybe a cheaper price if it's more expensive to sell to the U.S. Right? So they might actually benefit indirectly. I think everybody will hurt from a slowdown in the global economy from tariffs, but there might be opportunities where these companies are locally based. My number one stock in the fund is Ship Healthcare. We can talk more about that, but they do local consulting and help hospitals automate their IT systems and consolidate. And there's been a large push in Japan to get digital in their medical records. They're well behind the U.S. and Canada in that respect. So you think about that's not really going to be affected by tariffs. And if there's a global slowdown in the economy and there's additional kind of stimulus or fiscal stimulus from local governments or other countries to stimulate their own economies, they would actually benefit because that's a kind of government push. So they have got kind of both secular and cyclical tailwinds at their back. So I try to find companies that are cheap, out of favor, but good businesses and benefiting from what they do in the marketplace they're in. So I'm a little bit less concerned with kind of the macro and the tariffs.
Yeah. Okay. Fascinating. I mean, it's a fascinating, as you say, almost it could be a bit of a tailwind because of tariffs in that particular case.
Yeah, for some companies, they might actually benefit. And I didn't address your point on kind of the liquid alts or private equity perspective. A lot of these these kind of micro cap companies don't trade that often. So to some extent, they're just, when people are seeking liquidity, they often sell. It's kind of counterintuitive. They often sell their most liquid stocks first when they're on a risk off period. So sometimes these are less affected by a liquidity crunch, just in terms of how they trade. But also many of them are founder run, have high insider ownership, are just good businesses where they're small enough that they're attractive to a strategic or private buyer, but often they're kind of run by founders or insiders as well.
So how do you get at it in terms of analysis, in terms of making your decisions, fundamentals? You're known, very well known over the years working with Joe Tillinghast, as being very much a value investor. That's what you bring to this. How do you
Absolutely.
get into smaller companies and do the analysis that you need to? How does that work?
Yeah, so I use both quantitative tools and fundamental analysis. And I think the quantitative tools that I use provide a lot of breadth in terms of being able to efficiently look across a 7 to 8,000 stock universe, right? That's a lot of stocks. That's a lot of breadth to cover. And by using screening tools, by using stock picking models, I can effectively kind of get at the most interesting companies that meet that strict investment threshold that you talked about. Cheap stocks, high quality, ideally returning cash to shareholders. Um, so that's the breadth part. And then the depth comes from our fundamental analysts all across the world. Fidelity has one of the largest global research departments. And while they don't actively cover or rate a lot of microcap stocks, they actually do meet with a lot of them, which is kind of the interesting part. They'll go to conferences. Sometimes they're just interested in looking at new ideas. Sometimes companies reach out to them, and sometimes our analysts are trying to get insight on competitors, their larger competitors of these smaller and micro-cap companies. So there's a lot of reasons we might meet with them. They'll publish research notes in the system, so we have a record of what they think about this company. And what's important from a non-quant perspective is the management team. Are they any good? Um, are they having aligned incentives? Are they looking at an industry that's growing or not in secular decline? Do they have a competitive edge in the products that they're delivering? So that's kind of where I rely on our fundamental analysts to kind of screen out those companies and take that view. So the fund is also very aligned with their views. And because there's a lot of research that gets published, part of the reason we were able to launch this microcap fund is that in 2023, I embarked on a very large project to use AI and large language models to go back and read over 500,000 of our research notes over 20 years using GPT-4 and Llama 3.
Sorry,
And
how many? How many?
over 500,000 research notes. And that could take a long time, even if you're Joel Tillinghast, who's known for just voraciously reading research notes all the time. Um, this is, it's been a great exercise. And I actually have a process now that wakes up 3 times a day, reads all the research notes. Um, this is a large language model and sends me all the relevant information that I need to take action on the universe of stocks that I'm interested in or that I own, and kind of integrate that information very quickly and efficiently. So I like to tell people, Pamela, I'm using all the tools in the toolbox to get at the very best alpha, whether that's quantitative, fundamental. And another thing that quant is really good at is portfolio construction. It's a very mathematical exercise. So not just sector weights or geographical weights, but actually how these companies trade with each other. I have a matrix of over 1 million weekly returns from 8,000 stocks across 3 years of weekly returns that I'm using to kind of form very efficient portfolios. And that's the same process I used on global intrinsic value for many years with the low vol. So again, lots of effort and tools going into making a very successful microcap product, which is a difficult space for a normal layperson, I feel like, to kind of invest in and get their arms around.
Yeah, it's fascinating. And you mentioned earlier you're looking among all those other features for cash generating companies, but also some of them have dividends, which actually surprised me. Tell us a little bit about that. These are small
Yeah,
companies.
when we were chatting just before the call, you were shocked to learn that the fund has a 3% dividend yield of its holdings. So people don't always think about microcaps as being high quality, as returning cash to shareholders. But like I mentioned, a lot of them are founder run or have high insider ownership, and they actually are aligned with shareholders. So while the small and microcap benchmarks, the dividend yield on those is about half that of the fund, the stocks I look for are those that are generating cash, that are returning them to shareholders, that are high quality, and that are also cheap and out of favor, right? So that combination, I think, lends itself to a portfolio that will probably be lower vol than the benchmarks, that will be higher dividend, higher quality, probably lower beta, and ideally generate some alpha from finding good companies like that.
I remember over the years speaking to you about global intrinsic value, and there would, because you would invest in companies that were cheaper, they were on the value side of things, well run, and so on. They often, not often, but often enough, they were takeout targets because they're good companies and
Absolutely.
companies to buy them or acquire them and so on. Is it the same situation in the microcap?
Yeah, I'd say even more so because these companies are a lot more easy to digest for whether it's a private equity buyer or a strategic buyer, a competitor. We've actually had 13 companies get bought out from the fund since we launched it last May.
Wow.
Um, and that's been a combination of both private equity and strategic buyers, some at very, very nice premiums. So I remember our first buyout that we had, I was really excited about because it was in the first month of fund. It was back in June, and it was Park Lawn Corp, which is also a Canadian company, and they do funeral services. It got bought out at a 62% premium. And funeral services is a business that is cash generative, that's quite stable, so not very exposed to economic cycles, and has clientele that's less price sensitive. In the US, there have been two major players that have rolled up the industry in funeral homes and funeral services, and I think you're seeing that now also start globally. So Park Lawn's a classic example of a good company with a solid business, had a niche in their market, was underlevered, and was an easy kind of takeout target for that. And I can talk through others, but actually the smallest stock we owned was a car dealership in Japan. It was a 17 million cap, 17 million USD market cap company. So it was the smallest one we owned at the time back in August, called Takatsu. And again, car dealerships are a great business. I think Warren Buffett owns a lot of car dealerships, right? So they're just kind of, between the services and the new car sales, they often offset each other. So they're less exposed to economic cycles as you might think. And it was very cash rich. I think over half the market cap was in cash on the balance sheet with no leverage, single digit PE ratio. Like those are the type of stocks that are kind of easy buyouts if companies are willing to sell.
Do you recall what it got bought out for? Did you say 17 million cap? Is that what it
It
was?
was a 17 million market cap company at the time. I forget what the premium was, but I think it was quite good, somewhere in the 30 to 50% range, if I remember correctly.
So interesting. So in these markets right now, people are looking for diversification. This is obviously a way of getting that. But I wouldn't mind if you just kind of expanded on what we're in the midst of short term, which feels like a lot of tariff talk and just a global kind of upending, but maybe it also for these smaller companies will provide some interesting opportunities. You might be looking at the global picture, the global political picture differently.
Yeah, I think so. I mean, I think the companies I look at are, like I said, less exposed to tariffs, but I do think they provide a natural offset to portfolios that are kind of overly concentrated or overweight some of the crowded areas that I feel like are in the market. US, large cap, and growth are the three primary. This global microcap fund is kind of the opposite of those three themes. So I do think it provides some nice diversification from a risk perspective. Even outside of the alpha opportunity provided in this space, I think it's just a good kind of offsetting position. If you look at the last couple of weeks, the Nasdaq 100 in the U.S., which is the large cap growth, is down almost 4%, and global microcaps are down less than half that, 1.5% or so. So I think it's interesting to see how they're actually providing a bit of safety and calm in the storm, whereas people think of them as more risky. And I think partly, Pamela, that's a function of the valuations and just the crowdedness in some of those areas that I mentioned. That when they start to become high beta, and there's really no specific reason that they have sold off with tariffs a little bit, but they haven't been that affected by tariffs in the past. So I think it's kind of a risk perspective a little bit, and I do think they provide some calm in that. While I'm not as concerned about tariffs for my companies, I definitely think tariffs have the opportunity to slow down the global economy. So that is a risk in terms of maybe gravitating toward a higher quality companies, which the fund does by its very nature, by my investment process. Maybe the one area I'll highlight is energy.
Yes,
I
please.
think I think that if there's one thing that the U.S. administration and Donald Trump has been very clear about is wanting lower energy prices, and
Well,
you
and they
saw that.
have, and the global price isn't really doing a whole lot.
Yeah, I mean, it's kind of to its lower range of the past year or so. The crude prices. So I think it hasn't come down yet that much, but it's at the lower end of its range. But if you look at his first administration, I think he sees energy prices as a tax on the U.S. consumer. So if he's implementing tariffs, that's a tax, and if he can kind of offset that by lower energy prices, it might be a nice offset to U.S. consumers, to inflation in the U.S. And I think he's working very hard to end geopolitical conflicts, whether that's Ukraine and Russia or the Middle East. He's encouraged less regulation in the U.S. and more drilling. And in his first term, I think you saw him work quite closely with Saudi Arabia and OPEC, and you saw OPEC keep oil prices quite low then. So I think the one risk that I'm kind of keeping in mind is that the U.S. administration, the new administration, has been quite clear that they want lower energy prices. So while I'm kind of neutral to maybe even slightly overweight energy as a whole, it's all because of refiners and energy services, and I'm quite underweight the E&P companies.
That's actually fascinating. Tell us a little bit about the overweight that you have to Japan. Actually, traditionally, when you've been
They've been
managing
cheap for a long time, Pamela. Yes.
for a long time, but it's an interesting part of the world right now because it doesn't seem to have tariffs around it. Maybe I almost don't want to say it out loud because it might
I
get
know.
targeted, but it's
I'm not
not.
sure why they haven't gone after Japan. I guess they're just kind of under the radar. They haven't upset the administration in any particular way. But it's kind of nice that they've been not been the target of much tariff talk.
Right. Okay. And is there any reason to? So you're overweight Japan at this point, like within the fund.
I am. Yeah, the benchmark is about a quarter Japan in the global microcap space, and I'm probably overweight by about 500 basis points. So a little over 30% of the fund is in Japan. I think, Pamela, it is the cheapest developed market in the entire world. It's been out of favor for a very long time, last 35 years maybe, starting in 1990 with the collapse of their bubble. They actually have the loosest monetary policy in the developed world. While interest rates have gone up a bit, they're still in the 1% range for their 10-year bond. And their central bank actually buys equities, and they have historically. So very loose monetary policy still. Their currency has been weak, although strengthened a little bit recently, but it's still 150 yen per US dollar, so still pretty cheap currency. And they have very kind of high quality cash rich companies, very little leverage on the balance sheet of, especially down in the small and micro cap space. But I think what will actually change, right? All that's been true for a while, but I think you're starting to see really over the last 5 years, it's incremental. Things happen slowly in Japan, but you're starting to see a thawing of corporate governance, really poor corporate governance getting better. And anytime things go from really bad to just okay, that can be a catalyst for stocks, whether that's this or anything else. And I think you're starting to see companies be aware of their returns on investment, their returns on invested capital, that their balance sheets are very inefficient and a drag. And you've actually had the government and the stock exchange implement certain indices that say these are high ROE companies, and the central bank can only buy those. And it's this slow cultural shift, but I do think you're starting to see it. You're starting to see more buyouts in Japan. You're starting to see private equity become just a little bit more involved, and you're starting to see management teams get rid of their cross shareholdings, do buybacks, get rid of some of the cash on the balance sheet. And over 5 of our 13 companies that have got bought out have been in Japan.
So tell us a bit about how micro is micro. So you mentioned the smallest company in the fund before it was bought out was, I think, $17 million cap.
Right.
What now? How small is small? What's the range?
Right. I mean, I try to cast as wide a net as possible while still being true to the style. So my investable universe is about 7,000 to 8,000 stocks, and it's the smallest half of the MSCI World Small Cap, and then kind of the biggest 60% of the MSCI World Microcap. And I'm willing to go down there a lot, but once you get below like 15 to 20 million USD market cap, it does become somewhat uninvestable. So that's kind of the range from a kind of weighted average market cap perspective. And these are USD numbers just because I'm here in Boston and I think in USD terms. But if you think about, I'm going to talk about the MSCI World Microcap and MSCI World Small Cap. Benchmarks are like 300 million cap weighted market cap for the MSCI World Microcap and about 4 billion for the MSCI World Small Cap. My weighted average market cap is 750 million, so more toward micro, but I'll still be willing to venture up into the bottom half of the small caps. And I think this microcap fund is a nice complement even to a small cap fund that you might have, because often small cap portfolio managers tend to be a little bigger than their benchmark, and they kind of gravitate in toward the more liquid parts of small cap. So this kind satisfies the need for the kind of smallest of the small and the larger of the microcaps. So that's kind of how it plays out and how I think about it.
No, it's really helpful just to sort of get a picture of it. Much discussion about sort of the everything else trade, even within the U.S. Just the idea of interest rates coming down, and just a little more capital available for companies. Does that play into what you're looking at right now? Those are the fundamentals.
I do own a lot of companies that would benefit from a lower interest rate environment. I think U.S. banks. I own some European banks that have done quite well. So in our top 10 holdings, Sparbank in Norway was the number 2 holding, and Metropolitan Bank in the U.S. Was our number 5 holding. And I think that banks are really cheap in the U.S. They've been out of favor for a while, and while some might argue higher interest rates are more beneficial to them, really a flatter yield curve has been kind of difficult in that space. We saw a couple notable bankruptcies in the banking space a year or two ago as a result of the flattening yield curve. So I think there's some benefits there in the portfolio. It's not necessarily that I'm necessarily looking for higher rates, but I do think they're historically they're elevated, and if there's a theme of a somewhat slower economy, interest rates should come down a bit, and interest rate sensitive stocks, like certain financials, I think should benefit from that. So in the U.S., definitely that's a place where, in the vast universe of lots of money losing companies, many banks are trading at 10 times earnings and are pretty stable, and many of them actually do benefit. Metropolitan Bank is one that would benefit from lower interest rates.
I don't know if they're in the top 10, so you may not be able to talk about them. But do you own anything in Canada?
I do own some things in Canada. A couple of them have actually gotten bought out. Like I mentioned, MTY Foods is one of my larger positions in Canada, and I think it's kind of a typical stock where it's a franchisor of restaurants. They own some of their own. In Cold Stone Creamery, they own some pizzerias, both in Canada and the U.S. And they've kind of gone through some difficult times with COVID and then post-COVID, and I feel like that's kind of a slightly hairy but things getting better story at a valuation that's pretty reasonable. They just had a rough earnings report recently, but it's in a space that may not be as affected by tariffs, given the kind of the local operations, and just kind of restaurants can be a little bit more defensive in terms of just kind of overall economic cycles.
So I'm sort of fascinated by the research that you mentioned earlier on, because smaller companies, as you mentioned, sometimes some of the analysts will be looking at a particular company to value, and then they'll be looking at their competitors for valuation purposes. And some of those competitors are exactly the microcap companies that you're investing in or talking about, and you get at them that way. But it must be interesting just meeting people who have new ideas and have companies that are at this stage microcap. Is there a time, maybe just talk a bit about that? I want to ask a little bit about your exit strategy once they maybe earn too much for you. But first of all, the new ideas that come across your world.
Absolutely. I mean, I get new ideas from multiple perspectives. Sometimes they show up on my quantitative screens. Sometimes our analyst meets with them and hasn't in a long time. And kind of a new idea will pop up that way. And often, just kind of one research note saying this is a good company, and it's well run, and I'm probably not going to cover it, but it's kind of worth owning. It is all I will need in the microcap space, because the fund is quite diverse. It has over 500 stocks in it right now. So each individual company, there's not as much risk from each individual company, and that's kind of by design to some extent, and also by design from a liquidity perspective. It's a lot easier to trade 10,000 shares in 100 companies than it is, to trade 100,000 shares in one company, for example. So I think that diversification helps, but definitely our analysts will go on the road, and especially conferences, and kind of highlight opportunities, and they'll pretty quickly make it into the fund if it meets the criteria from a valuation and a quality perspective.
And maybe just as we sort of start to close out, just coming back to that idea of it being actually somewhat surprisingly a bit of a ballast in times where vol in other areas of the cap weighting can be large swings, and just kind of why it might provide a little bit of protection in other areas or two other areas that might be riskier right now. It's an interesting part of the
And
story.
I think it is dependent on the time period to some extent, right? I feel like you have a few things right now that they are underinvested in and really out of favor and really cheap as an asset class. So in times of stress, that can often be somewhat of a ballast. Is that valuation? If you look at U.S. large caps, they're trading at a 33% premium to their 20-year average, whereas international microcaps are trading at a slight discount to their 20-year average. So that if there's mean reversion there, that can provide some safety. Like I said, the microcaps are often very locally focused. So if you have a diversified portfolio across multiple geographies and they're all have their own kind of economic cycle going on, that's somewhat correlated, but not necessarily exactly the same. You kind of have different, countries doing well at different times, and that provides some diversification. So it's also that diversification aspect. And I think if you look historically, even just the microcap benchmark has been slightly lower vol than the small cap benchmark. If you look at MSCI microcap versus MSCI world small cap, microcaps have actually been slightly less volatile. So I think that speaks to that nature of it. And I think I've mentioned through good portfolio construction and through stock selection, avoiding the downside risk, can also be a balance, and that's on the stock picking side. So the risk also comes in from a bottoms up stock picking perspective that will lend itself to, Pamela, microcaps individually are quite risky. So if somebody came to me and said, I want to put 20% of my client's portfolio in this one microcap stock, I would say that's really risky because the dispersion, the distribution of returns in an individual microcap stock, they can be up 100% or down 100%. But when you own stocks, a lot of stocks, and you put them in a smartly constructed portfolio, you get rid of a lot of that stock specific risk. So if you can find the stocks that on average, more of your stocks go up 100% than down 100%, you can kind of win by not losing a little bit in that space. So that's part of the process is the bottoms up stock picking. That goes into everything I mentioned from the quant fundamental perspectives.
Give us, sign us off here with maybe a story of one of the top 10 that you could share with us. I think you've taken a look at Park Lawn, you mentioned before, and then also in Germany, some interesting examples. Is there one other you might leave us with?
Sure. I mean, I like them all, but maybe Katitas in Japan is an interesting one on the Japanese theme. They're actually maybe one of the more expensive stocks in the top 10. I think maybe the most expensive stocks, but still only at 16 times earnings, so still cheaper than the benchmark. But they have really good growth potential. They're a leading reseller of pre-owned houses through renovation in Japan. So they'll buy kind of either abandoned or houses that are not in good condition. They'll renovate them and then resell them for a lower price than the Japanese consumers can buy a new house for. And there's a lot of supply of these, which makes it quite profitable for them to do this because there aren't that many people doing this. It's had 10% earnings growth, and the demographics are really supportive of this. Pre-owned houses are taking share from new houses due to the cost competitiveness that I mentioned. And it's a well-run company that we have good coverage of. So I think that's an example of a stock that's pretty cheap, has good growth, that's just kind of appealing from a kind of secular perspective, and is a well-run company and is in a good space. So
thank you.
Yeah, that's just one example.
That's fascinating. I mean, just a company that is doing that, and as you say, in such a local way. And
very locally focused, right? It doesn't really matter what's going on in the US or Canada for them.
Absolutely. Salim Hart, you always come with fascinating ideas. Thank you for sharing some of the ideas in your fund with us and giving us a bit of a lesson on the microcap story and where it belongs today. All the best.
Thank you, Pamela.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.